Private investments in Germany. In Germany, there are various ways for private individuals to invest in a company. Here are some of the most common options. 1. Direct participation. Purchase of company shares, equity. In the case of corporations, example, GmbH AG, private individuals can become co-owners of the company by acquiring shares, example, stocks in an AG or shares in a GmbH. Direct participation in larger companies is possible through the purchase of shares on the stock exchange. In smaller, non-listed companies, shares are often acquired during investor rounds or through direct negotiations. Silent partnership. A silent partnership is a form of equity financing where the silent partner contributes capital to the company but does not appear publicly. The silent partner usually receives a share of the profits but is not involved in losses. 2. Crowdinvesting. Crowdinvesting platforms. Through specialized online platforms, example, SeedMatch, Companisto, private individuals can invest in startups or small companies. In return, investors often receive shares in the company or a profit share. This form of investing usually involves higher risk but also offers the potential for higher returns. 3. Bonds and loans. Corporate bonds. Companies issue bonds to raise capital. Investors lend money to the company and receive interest in return. At the end of the bond term, the capital is repaid, provided the company remains solvent. Subordinated loans. Private individuals can grant subordinated loans to a company. Unlike traditional loans, these are repaid only after all other creditors have been satisfied. Interest rates are often higher, but there is greater risk, especially in cases of corporate insolvency. 4. Venture capital and private equity. Venture capital, risk capital. Wealthy private individuals, known as business angels, typically invest in young companies or startups. These investments are often made in the form of equity or convertible loans. The focus is on companies with high growth potential, but there is also a high risk involved. Private equity. Private equity firms pool capital from investors to buy stakes in companies, restructure them, and later sell them at a profit. For individual investors, this is usually only possible indirectly through participation in private equity funds.